If you look at any profound wave in the market, there are always significant interruptions and breaks. And so the fact that there's been some period when things after a rally have gone down, I don't think proves anything one way or the other.
Former U.S. Treasury Secretary Larry Summers warns that investors are ignoring obvious risks in the markets.
The biggest mistakes people make in markets almost always take the form of doing today what they wish they had done yesterday. And so after there's a substantial decline, deciding that it's scary and that's the time to sell, or after there's a big rally, deciding they want to pile in. I think the people who will fare best through all of this are the people who try to reach a broad judgment and then adjust their positioning a bit, but are not super reactive to day-to-day market fluctuations.
RBC Capital's Lori Calvasina says that the attention the Magnificent Seven gets isn't exactly undeserved.
So I think part of it is the law of large numbers, and I think it's also the fact that different parts of the equity market have been on different earnings cycles. So a lot of it is, frankly, just, different things coming down the road. And back in 2022, you saw the Mag 7 actually experience a contraction in earnings growth. Then in 2023, they had this enormous, very, very fast ramp. And it continued to be strong in 2024, but it's coming down and it's just sort of losing steam. And that's just something that typically happens after you come out of negative growth. You experience your fastest ramp in those early recovery years, and then it moderates a little bit. What we found was that the rest of the market actually had its earnings recession, its contraction in 2023. And so then we got to sort of the supercharged part in 2024, and it's expected to continue ramping. And part of that's because it's been a little bit of a weak recovery out of the box.
We have seen something of a sell-off in the Magnificent Seven in response to the DeepSeek. We'll see how long that lasts. But does that indicate that maybe they were overpriced?
Look, this is one of the big debates that we've been having, not just in 2025, but I would say really over the last year, frankly, year and a half. And they are overpriced. The question is, does that overvaluation reflect excess earnings excitement that's coming around the bend? And so far, the answer has been a resounding yes. Every time it looks like that long-term earnings thesis is starting to fall apart, the companies come back and reaffirm expectations and get people all excited about the long-term thesis again. But it came under question earlier this week.
So it is fascinating that this concentration has been so durable. Yep. I mean, every time it gets challenged, it comes back. To what extent is that because something new comes along like AI?
I think that part of it is what's not coming along, right? And so these stocks have been so crowded because they're essentially the best game in town, and they're offering the best earnings growth prospects, both in the near term and the longer term. The rest of the market, we have seen earnings expectations ramp back up. If you look at S&P x Mag 7, for example, but even though they're experiencing a ramp up, an earnings growth recovery that's forecasted to go through 2026, it's not able to overtake the decelerating growth of the Mag 7.
What are the risks in having this level of concentration for this long a period of time?
Well, I think we saw it earlier this week, right, which is that the sentiment gets very skittish and investors get very nervous, and there is an underlying itch to rotate in the market. And I see that very clearly even when I talk to growth investors, right, who are having a fantastic run, but there's a nervousness. And so any little bit of bad news can come in and turn things around very quickly. And when we talk about the broader market, I mean, on my stats at least, the top 10 market cap names in the S&P 500 are about 40% of the market cap. You are going to damage the broader market if you do damage the prospects for those top 10 names. And so it can be quite painful. And when you've got skittish sentiment, it can feed on itself very quickly.
Market concentration is one of the reasons the Magnificent Seven have had such sway over equities. Monday's sharp decline in the S&P 500 came even as a majority of stocks in the benchmark index rose. And Goldman Sachs' David Kostin says investors can't count on that outperformance continuing.
The implications of high concentration are It was a result of excellent performance, and while the performance of these companies will still be strong, it's going to be less dramatically greater than the rest of the market. And I think that's an important implication for calendar 2025 as you think about the investment environment for the coming year.
And is that a matter of history or maybe reversion to the mean? That is to say, you simply can't have that kind of extraordinary profit over an extended period of time.
Well, this actually is a critical issue in conversations that we have. We want to look at the entirety of the investment community. I spend time with sovereign wealth funds, pension funds, endowments, insurance companies, family offices, and they are interested in particular in long-term returns. The mutual funds and hedge funds, of course, are also interested in long-term returns, but specifically they're often managing with a shorter duration in terms of their return profiles. So you take these larger organizations and they're looking at what kind of returns are they likely to generate in the U.S. equity market over a long period of time. And that, David, is where high concentration has important implications. Because, as you pointed out, we are at the highest level of concentration as we've had in about 100 years. And so when we think about valuation and what information does that imply about forward returns, and high concentration and what does that imply, when you put those things together, it tends to suggest that the aggregate index, which is where the concentration really is embedded, that is likely to have relatively low returns. Whereas the typical stock, the broadening of the market, is likely to have much greater returns. And so, to put some numbers around that, probably around 8% annualized return for an equal weighted portfolio, where something below that, maybe 500 basis points lower than that, and an aggregate index, and the consequences of that is a result of the very high starting point of concentration.
Which may make these very good businesses going forward, as you say, but that doesn't necessarily mean it will continue to grow in their income and particularly their profits.
These companies have had spectacular growth in earnings and profits and their sales, and they've had an opportunity to make that global. And so that's been a terrific story, and that's likely to continue to be excellent companies and probably still grow with their earnings. But the growth premium, the premium growth rate, which has been so alluring to so many portfolio managers, in our expectation is likely to narrow relative to the rest of the market. And that is where I think the opportunity for a broadening of the market, and that's our expectation.
When we talk about NVIDIA right now, we are mindful of what happened with the news of DeepSeek and what happened to NVIDIA stock, others as well, not just NVIDIA by any means. Is it too soon to tell whether there may be ramifications more broadly for the tech sector from what we're seeing in DeepSeek?
Well, it's interesting. We had the Goldman Sachs Global Investor Conference in Hong Kong a couple of weeks ago, and people were talking about that in the various meetings that I had. I think what seemed to be galvanizing and arresting to a lot of people was the alleged cost, or the estimated cost, that was perhaps a relatively modest amount, at the same time that other big companies were talking about tens of billions of dollars of CapEx. And I think that is what really caused people to ask, what is the ROI of this investment? Could you actually develop this kind of a product with a relatively, call it shoestring budget, as compared with a much more substantial CapEx? And so I think that's where a lot of questions, comes back to this question: what's that ROI? What's the return on investment likely to be of the AI? And I think that's where the source of the debate in the conversations we have with portfolio managers right now is sort of centered on this question.